Welcome everyone back to the Harry Sale Wealth Show. I'm here with Jesse Merson. He's our first returning guest. So Jesse Merson, welcome back to the show.
Thank you, Harry. It's amazing to be back. Thank you, and looking forward to it.
People come to me and they ask me all about real estate questions. So we thought we'd have you back. Obviously, there's a lot going on in terms of the markets right now, interest rates, and a number of things. So why don't we just start off, give us a state of the union in terms of where you think Canada's market is right now and kind of the trends that you're seeing.
I'm really kind of seeing two sides to the market right now. I think the majority of people are sort of, hitting the pause button just because is so unstable. We don't know what tomorrow brings right now. And so going out and buying a home, making that major purchase, taking on a new mortgage, it's a lot tougher to do in an environment where literally we don't know where we will be economically, tomorrow or, a few months from now. On the flip side of that, I'm seeing a lot of people that have taken the time to prepare, talk to professionals, real estate agents, their advisors like yourself, a mortgage professional, and the time is right for them to go out and buy. And there's opportunities out there. I had a client, first time home buyer, perfect. Condo was listed for 745 and they got for 685. So there's deals out there if you're prepared and you are sort of in this for sort of the longer term. Obviously, anybody that's looking to flip a home or making a quick buck, that's really not an environment we're seeing right now. But I think overall, there's a ton of pent up demand. We just need to see some stability, and that will bring, I think, the majority of buyers and sellers back to the market. Active listings are up quite a bit, but again, we need some stability and confidence for buyers, I think, going forward.
Yeah. Do you think the trend that we're seeing is that the Bank of Canada should be lowering rates across 2025? Are you seeing that? Any predictions in terms of where they might be towards the end of the year?
There's a number of compelling forecasts for both rates to come down as well as go up, actually. So if we look at the very short term, so April 2nd, which is coming up, that's when, the bulk of the tariffs are to come into effect. That is a negative thing for the economy. And so therefore, one would expect that rates could potentially come down. Last week, the Canadian inflation number jumped up. It was actually higher than expectations. The tax break we had over the holidays, is over. And so we saw inflation come up. And so that puts the Bank of Canada into a tough spot come April at the next decision with inflation going up, but the economy sort of, looking good in the short term. Where is it they're going to go? I think if you look at the average forecast from, let's say, all the big banks going forward throughout 25, I think the average is about another 0.5 to 0.75% down. So that could be potentially another 2 to 3 cuts. On the flip side of that, trade wars tariffs and trade wars are inflationary. And so although in the short term, we may see some easing in rates, at the end of the day, if the trade war and these tariffs carry on for an extended period, it could result in much higher inflation. And then, of course, we all know what happens there. The Bank of Canada would be forced to raise rates. I think volatility and a bumpy ride is sort of what we're looking at for the next little while.
So volatility, bumpy, maybe in the interest rate section. What about the pricing part? Are you seeing any
Yeah,
trends coming down? Are you seeing condos or houses moving independently? How are you seeing in terms of pricing?
that's a great question too. And I think it depends on the home type. So condos, obviously, there's quite a few of them in downtown Toronto and across the GTA. And so we've seen prices soften there considerably. There's deals to be had. There is obviously a high concentration of investors in the condo market. And so I think a lot of the, shall we say, mom and pop investors are perhaps feeling the pain a little bit because rents are coming down and whatnot. So again, deals to be had there. In terms of semi-detached and detached single family homes, I think there's still quite a bit of demand there. In fact, we are seeing some bidding wars here and there for good homes in good neighborhoods. So it's still not uncommon. And then, of course, when you sort of jump up into what we'd call the luxury market, as soon as you start approaching, a $3 million purchase price and above, you start to get away from interest rate sensitivity the higher you go in price. And so, if you're talking ultra high net worth clients or high net worth clients, they may not be borrowing money. So interest rates and the ups and downs may not be part of the decision making. But yeah, I think we're seeing a divergence in condos and housing. I think at the end of the day, again, if you have a long-term time horizon, whether it's going to be your home or an investment, I think there's some great deals in the condo market for sure, if you buy in the right neighborhood and in the right building as well.
Yeah. Yeah, it's really good to hear. I know there's a lot of people, we always hear this term waiting on the sidelines. So I've had a lot of clients that really say to me, how can I prepare as best I can to launch a down payment? Or, when my area becomes a little bit cheaper or the rates come down, how can I be prepared? In terms of the financial planning side, obviously that's what I deal with my clients. But in terms of your clients, how are you preparing them, I guess, for what might happen, whether it be a better market if prices come down or worse market, maybe if these tariffs get increased and maybe the Canadian economy isn't so steady. So how are you preparing your clients?
We complement what you would do as a financial advisor. We sort of have a little bit of a different lens on the planning that we put into place because to your point, we're going to look to the future for, interest rate fluctuations and whatnot. But often with our clients, we will go through a budget and sort of take a look at what they're spending money on. Is their discretionary income at the end of the day? How much of an impact would there be on their household if they chose a variable rate mortgage and rates did go up 0.5% or even 1%? And so that's where everybody's situation is a little unique. Perhaps some people are comfortable with the variable and have the, income to offset potentially higher rates in the future, and maybe they don't. And so maybe that's why a fixed rate would be better for those individuals, right? So there's definitely a lot of planning and some conversations around that. Obviously, we have no crystal ball. We don't know where rates will be in 6 months. We can only take the best of what we know today and use that as our decision making. But I also tell my clients, go with your gut instinct, go with what you're comfortable with. If you're going to lose sleep over, thinking about your mortgage rate, then, perhaps a fixed rate would be best, right? So, yeah, there's definitely a lot of planning, especially when things are, in an environment like we are right now. Prior to the pandemic, things were quite stable. There weren't really major headlines impacting the nation as a whole as often as they are today. And so, the conversations were different. But yeah, a little more in depth these days, which is great because what you want to do when you buy a home is be 100% confident with that purchase.
And then quickly before we switch to mortgage strategies, are there any key indicators that you kind of look at as an inflection point? Like, for example, if the interest rate crosses 2, maybe you're expecting a boom. Any sort of key indicators you're looking for this year?
Yeah, I think, yeah, absolutely. So obviously we're keeping an eye on bond yields. Bond yields were something that we would maybe take a look at. Again, this is prior to the pandemic, maybe, once a week or something. Things were quite stable. Then we started to look at them, daily, and they would be fairly stable throughout the day. It's not uncommon, and especially in the last few weeks, to say 5 to 10 basis point swings in, bond yields. And so bond yields, of course, will impact fixed mortgage rates. Now, a lot of people I have a lot of conversations where, for example, the 5-year bond yield is down about 0.4%, 40 basis points since the start of the year. Fixed mortgage rates haven't actually come down the same amount. And the reason for that is that lenders are applying a risk premium within the mortgage rate because of the instability in the market. Again, these lenders, these big banks are made up of people just like you and I. And again, they can only use the best information they have at their fingertips today to know or forecast where we're going to be tomorrow. And so because of that uncertainty and that unknown, there's a little bit of a premium. And so yes, mortgage rates have come down a bit. Mortgage prime has started to come down a bit. So obviously things that we take a look at. I think at the end of the day, rates are going to be where they're at. And so you got to look at your family and your personal situation and say, okay, is this the right time for me to buy? Don't try and time rates because, I always, the funny thing is I like to ask my clients, like if rates went down 1% today, okay, would you buy a home tomorrow if the price were to go up 10%? Because obviously as rates go down, prices will go up. That's kind of a fact. And so, if you're looking at the average home price in Toronto, $1.15 million roughly, that home price is going to go up $115,000. Whereas on an $800,000 mortgage, let's say rates go down 1%, you're only saving $40,000 over the 5-year term. People get so caught up in the interest rates, they tend to forget about the other things, not to mention land transfer tax is going to go up on top of that higher purchase price. So yeah, again, it's just thorough conversations around the market environment.
And this is why people should be talking to you.
Well, and yourself, right? Because, it's all about planning and buying a home is a major financial milestone. And so it's important to know how it's going to impact your savings for the future, your retirement. So absolutely. Yeah. Talk to the pros.
And then I know you sort of touched on this. A lot of people might say, Harry, we're kind of waiting for a pullback. We're almost there. I don't know, rates are coming down. So I'm just going to wait a little bit. Is there any point in saying today, I should lock into a mortgage rate now relative to waiting for further decreases? Or is it just to your point that you just mentioned, your house is your house. If you need it, you should grab it. But just in terms of those people who might say, I'm just
Yeah.
waiting a little bit longer, what would you
Yep.
say to them?
Yeah, and I can totally appreciate that. I think the question is, well, why are you waiting, right? And if it literally is just to simply try and time where rates are going, I mean, that's tough, right? Having said that, if that's what you're looking to do is time it and your concern or your thought is, okay, well, rates are going down. Well, don't hold off on the home purchase price. There's ways to play that. Go with a variable rate mortgage. And if rates go down, your rate is going to go down. And if things turn and perhaps the outlook is that rates are going to go up, pretty much industry standard with any variable closed mortgage, you can convert out of that into a fixed rate term at any time without paying a penalty or a fee. So that is a strategy a lot of people are using right now that maybe historically wouldn't choose variable, but are looking the short term horizon going, yes, okay, it looks like rates are coming down. I need to buy a home right now. I'm going to go variable with the sort of, I like to call it an insurance policy that if rates turn and rates start to go up, you can flip into a fixed later. And so there's a lot of people going variable today, based on what we are based on what the forecasts are today, with rates going down perhaps into spring and summer, and then maybe fall, winter, they start to increase again. Well, maybe at the end of summer, we look at converting those variables into a fixed rate, right? So again, if you're trying to time it, it's very tough. I'm sure you'd have the same conversation with your client if you're looking at a potential stock. Yes, you want to try and time it, but also, you would probably say, well, don't buy it at its high, obviously, but don't try and time it too well because who knows what tomorrow brings.
Yeah, exactly. We get the same question about should I buy, into the stock market today versus tomorrow. It's very difficult to predict. So at least in terms of the interest rates, they have a projection, but we never know what's going to happen, especially with tariffs on
Right.
April 2nd. So stay tuned on that. One of the questions I was going to ask you is what about innovative financing options in 2025? Some people might come to me and say, Harry, I thought we could only do a variable for 5 years or fixed for 5 years. And you just mentioned something in terms of, having variable and then switching to fixed. What kind of different strategies that might be different than the buy the 5-year fixed or 5-year variable
Right.
would you suggest to a buyer?
Yeah. So there's a number of strategies. Again, the variable one I just mentioned is one that's interesting for anybody comfortable with the variable rate. The other one would be just choosing a 5-year fixed rate. So if you did that today, your mortgage matures in 2030, which is after the current presidential term. And so if you're concerned about volatility over the next few years, there's an easy way to sort of ride that out without any impact to your borrowing rates whatsoever. The other option, which is always definitely worth considering, is the hybrid approach where you can split your mortgage up into multiple segments. And the hybrid approach or the diversification approach is, a fixed rate component as well as a variable rate component. A lot of people that I talk to don't know you can do this. It was never introduced to them or advised to them when they first got their mortgage. So these are products typically offered by the banks. You do need at least 20% down towards your new home purchase, or if you are a current homeowner, have at least 20% equity in your home. So, let's say your house is worth $1 million, your mortgage balance would have to be 800,000 or less. And you can have one of these products. They typically will tie in a line of credit, right? And you can split your overall borrowings into multiple segments, and it just allows you to diversify. And so, if you like the stability of a fixed rate, you could choose to put, say, 70% of your mortgage into a fixed rate term. But if you also want some exposure to, rates potentially going down, well, then you could put the other 30% of your borrowings into a variable rate term. And it just gives you the best of both worlds. And it's a similar approach to, your clients and diversifying. Same thing on the mortgage side. Gives you exposure to both. It gives you a safe harbor on the fixed rate side, but also exposure to, savings on the variable rate side. So that's a good one that I think everybody should sort of consider if they do qualify for those type of products.
Yeah. Is there maybe a certain type of person that may or may not, you might not recommend it to, or anybody that, should stay away from that?
I don't think so. I think everybody should at least know that it's an option, to be honest, that they can do that. Again, my job is to listen to my clients and find out what their goals are for today and tomorrow. And I think typically the hybrid approach is an option that a lot of people should at least know about. Whether or not, they ultimately choose to go that route at the end of the day, that's sort of their decision. But I think it's something that people should be aware of that you can do. A lot of people have these products and are all in on a fixed rate or all in on a variable rate. They don't know that they can split it up into multiple segments. So another interesting way to play that would be let's say you're all in variable and you qualify for a product where you can do the multiple segments. One way I like to structure it is, perhaps you could have two, let's say you're borrowing $500,000. You could have one variable segment for 250,000, another for 2,000. They're identical, same rates, amortization, everything. And if rates turn, and let's say the outlook is they're going to go up, you now have the option of converting just one of those segments to a fixed rate term. You don't have to convert the entire balance, right? If you said, okay, I just want to still maintain some variable exposure, because there's a chance maybe it's short-term blip, they go up, but overall trend is downwards. But if you do get a little nervous, again, you can just convert one of those segments and it allows you to still maintain both with the conventional mortgage, or if you've got one of these segments with multiple segments and you're just one variable segment, you have to convert the entire balance, right? So that's another way to sort of play things. There's a number of strategies, and the economic environment at the time will sort of put other strategies at the top of the pile versus others. Right?
Yeah. That's fantastic. It's sometimes you just don't know if you don't ask the right questions, and obviously to speak to somebody like yourself and who has the plethora of options that you can offer instead of just at our bank. It's really important to know what's out there. So that's really important information. Appreciate that. Let's just switch a little bit towards some of the advice that you might give in terms of people who might have lower credit or higher debt to income ratios, especially these days, considering that we're seeing we're seeing insolvencies rising. We're seeing credit card debt increasing. What are the options for people who might have a lower credit score or higher debt to income ratio?
Yeah, so great question. And obviously, yeah, something that's come up quite often. And we have a lot of clients that are doing consolidation loans. And so there are a ton of options, quite frankly. There could be a bank option. There could be an alternative lending option. The reality is, I think that if you should at least know your options, right? And so don't sort of get yourself into a corner where you're kind of stuck. I would say try and think ahead down the road. And if you find yourself with some credit card balances adding up, lines of credit, maybe you've done some updates to your home or whatever it is, it's a good time to sort of take a look at that and see if you can ease things. One of the biggest priorities of my clients that I'm hearing right now is to be able to lower their carrying costs. Life is getting more expensive everywhere you turn. And for many people, mortgage payment is the highest, payment they're making on a monthly basis. And so if you can ease that a little bit, that's fantastic. I find a lot of people that are just simply renewing right now don't realize that you can actually re-extend your amortization out. So let's say you have 15 years left on your mortgage. You're going from a 2% rate to a 4.5% rate. Your mortgage payment jumps up. You can actually adjust your amortization from 15 to 20, 25, up to 30. And perhaps that would allow you to ease the payment a little bit and ease that payment shock. I find that a lot of clients I'm talking to that are coming directly from the banks, for example, aren't told this information. Obviously, it benefits the bank, the shorter the amortization, because it lowers the risk overall. But that's something that we can take a look at. And yeah, consolidation is a good one because typically any other outside debt aside from the mortgage is going to be at a much higher interest rate. And even line of credit or secured line of credit balances, if you've got, 100, 200,000 or more owing on a secured line of credit, you're really only paying the interest every month, right? At prime or prime plus a half. You can convert that into a mortgage or consolidate it into your mortgage at 4.5%, with the lower payment overall and actually start to repay some of that money that you've borrowed. Again, that's part of the planning, part of the budget process that we go through with our clients and take a look at. I just love being able to call a client back and say, listen, I can save you $1,000, $2,000, $3,000 a month in interest and lower your payments. And we're going to pay things off, make life less stressful. So there's a lot of that right now.
Yeah. It's an interesting time for sure. I know a lot of people, of course, bought houses 2020, 2021, 2022. So we're starting to see a lot of renewals. I am seeing on the opposite side with people who are maybe at their forever home, who might have a lot of equity in it, who might want to say, what I should do is, get some money, some equity out of the house and then use it to invest and deduct some of that interest.
Yep.
I'm just curious if you're seeing an uptrend in that or what kind of advice you would give people who might be considering doing something like that.
So there would be sort of, I guess, two types of people that would be looking to do that. If you have enough income to qualify at a bank, okay. So if you have, whether it's, old age security, CPP, pension income, any investment income that you've got, all that income that you're earning today helps you qualify for a mortgage at a bank, right? That's what banks look at, is what's your income on your tax return, et cetera. That may qualify you for 4.5 times income, depending on your income level, perhaps maybe a little bit more. And so that would be great. Yes, you could set up a line of credit, you could take a mortgage and use that money to supplement your income, or to your point, invest it and deduct the interest expense and whatnot. The other side, and I'm definitely seeing an uptrend, on my side, is reverse mortgages. And this is a great product for those individuals that do not qualify at the bank for whatever reason. Or perhaps the bank says you qualify, we'll lend you this, but it's short of what they're actually looking for. Perfect example I have of a client I worked with recently was, these clients are a little over 80 years old. They have a beautiful four-season cottage up north, and that is their primary residence. And they're on a fixed income, pension income, little assets overall outside of the house. And so they qualified for probably 4 or 5 times more than what a bank would give them as a reverse mortgage. And a reverse mortgage is amazing because you don't have to, the question is, well, I'm on a fixed income, I don't know if I can afford the payments. With reverse mortgages, there is no repayment. The interest accrues over time, and then you pay it off in the future when you sell the property, or, if there was money to pay it off at some point. So again, it all comes down to the discovery stage with the client, and sort of saying, okay, well, what's the money for? Tell me about your income and assets. And then from there, we sort of, continue the conversation into what would be an appropriate product. Overall, demographics are aging. I think, in the past, a lot of people that would retire and whatnot would sort of move outside of city centers, metropolitan areas. That's not happening as much. People want to be around their kids. People like to be near the restaurants and be able to walk everywhere. And so there are a lot of our clients that are, 55 plus, have a tremendous amount of equity in their home and are looking for a great way to supplement their income. Again, a reverse mortgage can be used to invest with yourself and generate an income. It can, you could borrow $1 million, put $500,000 into a portfolio with you. And then the other $500,000 sort of drip it out to yourself as a tax-free income over time. So there's a number of ways to structure them. There's 3 main lenders that offer reverse mortgages, and there's little nuances to each, but that's exactly where sort of I would come into play and figure out what product is best. Yeah, it's a great option for sure.
Yeah, that's why it does pay to speak to somebody who's independent, not affiliated with only one institution, such as yourself and myself. So really good to hear that. We'll just
Well,
switch
reverse
gears.
mortgages, sorry, I was just going to say quick, reverse mortgages you can't get from a bank either. So you do have to go to a broker, right? So it's one of the many unique products that we have access to that you're not going to find, going directly to your bank branch.
Excellent to know. We'll switch gears into a bit more of the scenario questions, because as basically a personal CFO to my clients, I get asked a lot of questions independent of investing, such as buying real estate or restructuring, or things that we've reviewed earlier today. So I have 5 questions. I'm just going to rapid fire over to you.
Cool.
Supposing you're in the meeting with us, I'm really curious what you would say to the client in person. The first one that I got was, I'm considering buying a home, but rates are expected to drop further. Should I wait or act now?
Well, I would say to that client, listen, if you have a home in mind that you really like, there's a way that you can buy it today and ride the rate wave down. And that's a simple, variable rate mortgage. And if there's any hesitation with that, again, going back to what we mentioned before with the ability to switch to a fixed rate, it accomplishes home ownership for that client. It allows them to have exposure to rates coming down. And then if things turn later, they can lock in if they ever wanted to. So that would be my advice for that sort of solution. Again, maybe there's some nuances there depending on financials and life situation, but I think generally that would be a good reply.
Great. Question 2, my mortgage renewal is coming up and I'm unsure whether to switch lenders or stay with the bank that I'm with. What factors should I consider, and do I have to requalify for a mortgage if I'm switching lenders?
Yes, absolutely. So you do have to requalify if you're looking to switch lenders. Even if you stay with your current lender and you're going to refinance, you do need to requalify again as well. So a lot of people don't realize that, but that's how it works. And I would always review options. I think the reality right now is that because lenders aren't growing their mortgage portfolio as they once were, retention is key for banks and every lender at this stage, really. And so we are seeing some pretty aggressive renewal rates. Again, it doesn't hurt to look outside because there are a lot of lenders that have, say, cash promotions. A lot of lenders will waive any fees associated with switching. Perhaps you can get a better product at a different lender. And again, Harry, to your point about refinancing and whatnot, at renewal time, that is a perfect touch point to revisit not only your mortgage, but just, your overall financials. And so this is where we partner together, for example, or your clients should be, sort of coming to you and say, oh, the mortgage up for renewal. Is there anything I can do? One easy way to leverage your home equity would be to top up your RSP, right? Return on your money that you can use to then, partially pay off what you've borrowed. So there's a number of things to take a look at. But yeah, I'd say at renewal time, don't just take the first offer that's presented to you by your current lender. Take a look elsewhere and see what's out there.
So they should give you a call.
Well, absolutely. I mean, there's a lot of lenders out there that would love your business. And so why not? I think, mortgage holders are in the driver's seat today. Why not find out what the options are and then make a decision?
Perfect. A third question, what are my options to keep my payments similar if my interest rate is significantly higher than when I last applied for a mortgage?
Yeah, so there's a number of things you could do. Again, you can increase your amortization, right? So that would help. There are some things to consider there. Obviously, again, going back to my earlier example where you're currently at 15 years and maybe you want to extend it to 25 years, you want to take a look at what the interest impact is going to be. Obviously, extending your amortization will increase your interest costs over the long term. However, it will result in a much lower payment versus a 15-year AM. So it depends what your priorities are. Again, keep in mind for the future, there's a lot of prepayment privileges. You could make lump sum payments, double up payments, etc. If you would like to keep your amortization about the same, payment shock is a reality for you. If you have the ability to use any other funds to pay down the mortgage balance, that's an option as well. Again, I would engage, Harry, you're someone like yourself to sort of say, okay, if I'm going to pull money out of a portfolio and make a mortgage payment, what am I earning on my investments versus what am I paying in interest? Typically, mortgage rates are going to be lower than the rate of return on an investment. So maybe not the best solution, but yeah, reduce your principal amount. I mean, the primary drivers of mortgage payment are going to be your mortgage balance, interest rate, and amortization, right? So those are the three levers you have to sort of take a look at and, which one works for me to sort of leverage.
Fourth question I had, before I buy a home, should I close down any lines of credit or unused credit cards? I get a number of questions about, should I consolidate? Should I reduce some balances? Should I increase it? Get my credit score up? So maybe it's a two-parter in terms of what can I do to prepare my credit score ahead of time? And maybe should I close down any lines of credit or unused credit cards?
Yeah. So available credit can sometimes come into play. Typically, if there's a zero balance owing, it's not too much of a concern in that, you could have a couple of credit cards. That's not uncommon whatsoever. Having a line of credit or two is not uncommon. It's as soon as you start to use those credit cards, here's the reality with credit cards is that, a lot of my clients will tell me, I pay my credit card down in full every month. And that's amazing that you do that. That will drive your credit score up. The reality is though, when your credit card company sends information to Equifax or TransUnion, it's going to be mid-payment cycle, mid-statement cycle, right? So even though you pay your credit card off in full every single month, it's still going to report to the credit bureau agency with the balance owing. And so that will trigger a payment that lenders will factor into, your application, right? Credit lines are a little bit different. If there's a zero balance owing, typically there is no payment that is triggered. It's as soon as you borrow $1, the limit of that line of credit results in a payment. So, yeah, you want to take a look at that. Again, engage a mortgage professional to sort of say up front, let's take a look at your credit bureau. What's on there? What things can we do? Another thing I like to take a look at, especially with my first time home buyers is let's say you're paying, $500 a month for a car loan and the balance owing is $20,000. If you were to pay off that car loan, okay, and free up that $500, it goes a lot further in mortgage money than it does in car loan money because a car loan's amortized over, 4 or 5 years, for example, whereas your mortgage is probably going to be amortized over 20 years. Instead of paying $500 for a $25,000 car loan, pay $500 and perhaps be able to borrow an extra $75,000 or whatever the number is on your mortgage. Again, not everybody's into that. It depends on the financials. Maybe you're self-employed and you want the deduction for the car loan. But again, It's just one of those things that we would take a look at in the planning phase. So yeah, it's always a good idea to, as soon as you start to get in your head, okay, I think I want to buy a home. The reality is most banks, if you log into your online banking, will allow you to pull your credit bureau or review your credit bureau for free. And you can even request a copy of your credit report from Equifax and TransUnion once or even twice a year for free. And it does not count as a hard inquiry or anything like that. And so that's something that I would encourage everybody to do, just also from a fraud prevention piece, but just to get a handle on how things look and run that by your mortgage professional to say, is there anything I can do here to improve my,
Perfect. Last question. I work with a number of incorporated professionals and business owners who typically have a varying and fluctuating income. Some of it's salary, some can be commission, or even one of each. They really are kind of wondering to me, do I have to increase a bunch of income to get my team or my business income showing that I made a lot, even though I made a little bit last year? Really what I'm trying to get at is for self-employed business owners, how can you help them qualify for the best mortgage rate?
Yeah, so there are a lot of lenders out there that understand and appreciate the setup of business owners. So, if you're a medical professional and you have your professional corporation, there's a lot of lenders that are in tune with that. If you are a real estate agent or a mortgage broker or anybody that's incorporated for that matter, there's a number of programs out there, a number of lenders out there that will, turn the focus away from your personal tax return and look at your corporate financials to help build, a stated income. There's lenders out there that if you're newly self-employed, newly incorporated, will take a look at your business bank statements and extract a stated income or be able to forecast an income from deposits in that bank account. So there are a number of options out there, depending on the program, depending on the lender, depending on the financial situation. Down payments may need to be increased. There are high ratio options for self-employed incorporated clients as well. High ratio would mean you're looking to buy a home for, and put down less than 20%. So again, I think the bottom line is there's a number of options. Talk to, somebody about what those options are, have them take a look at your personal situation, and there's going to be something out there that will allow you to buy that home.
Beautiful. Well, that's it for today. I really do appreciate your time, Jesse. There's tons of information. Thank you very much for joining the show and hope to have you back again soon.
Yeah, I can't wait. Great to see you, Harry. Anybody has any questions, call me, email me. And hope to see you again, Harry. Thank you so much.